The Atlassian Paradox: How a $10,000 credit card built a $98 billion company. And what killed it. At its peak, Atlassian was worth $98.68 billion. Today, it trades at roughly $22 billion. That's a 77% collapse in market capitalization. But here's what makes that number strange. Revenue has grown every single year. In 2021, when the stock peaked, Atlassian made $2.09 billion. By 2026, it's on track for more than $6 billion. The company is generating 3 times the revenue it was at its all-time high, and the market has cut its value by 3/4. So what exactly collapsed? It wasn't the business. It was the idea of the business. And understanding why requires going back to the very beginning. In 2002, two 22-year-olds in Sydney, Australia, set out with a specific, modest goal: earn the equivalent of a graduate-level salary, about $48,500, without working for someone else. Mike Cannon-Brookes and Scott Farquhar had met 4 years earlier in a co-op scholarship program at the University of New South Wales. They had no venture capital, no angel investors, and no sales team. What they had was a $10,000 credit card and a frustration with bad software. They named the company Atlassian, after the Titan Atlas, because Atlas.com was already taken. Their first product was Jira, a bug tracking tool whose name was a truncation of Gojira, the Japanese pronunciation of Godzilla, a nod to the competitor tool Bugzilla. The product launched in 2002. By 2003, they woke up to a faxed purchase order from American Airlines. The transaction had happened entirely online, without any human sales interaction. That fax changed everything. What Cannon-Brookes and Farquhar really understood at a mechanical level, was that enterprise software didn't need to be sold. It needed to be good enough to be bought. So they built a model around that insight. They published prices publicly. They offered free trials. They reinvested up to 47% of revenues back into R&D instead of paying quota-carrying sales reps. The result was a self-reinforcing loop. Better product, more users, more word of mouth, lower acquisition cost. By 2010, Atlassian had crossed $100 million in annual revenue. Without a sales force. The second insight was stickiness. Atlassian didn't build one product. It built a system. Confluence for documentation. Jira for project tracking. Bitbucket, acquired in 2010 for code repositories. OpsGenie, acquired in 2018 for $295 million for incident alerting. Trello, acquired in 2017 for $425 million for visual task management. Jira Service Management for IT operations. Loom, acquired in 2023 for $975 million for async video. Each product worked better with the others. A developer using Jira would invite a project manager to view a backlog. That project manager would set up a Confluence page. That Confluence page would link back to a Bitbucket repository. Suddenly, an entire organization was running its institutional memory, its code, its workflows, and its incident response inside one interconnected system. Analysts called it software quicksand. Once you were in deep enough, the cost and risk of migrating out exceeded any conceivable benefit. This isn't just a metaphor, it's a structural economic reality. Atlassian's customer retention numbers reflected it. The business had remarkable pricing power, and it barely needed to advertise to use it. When Atlassian listed on the NASDAQ on December 10, 2015, under the ticker TEAM, it priced at $21 per share, above its expected range. On its first day, it closed at $27.78. That's a 32% jump. Market cap on day one, $5.8 billion. What made the IPO unusual wasn't the pop. It was that Atlassian had been consistently GAAP profitable for a decade before going public. In fiscal year 2015, the company reported $319.5 million in revenue and a net profit of $6.7 million. In the era of money-losing growth companies, that was almost eccentric. Then came the pandemic, and the capital markets lost their minds. Enterprise software companies became the most valuable businesses in the world almost overnight. Every company needed remote collaboration tools. Atlassian's products were exactly that. Revenue grew $1.61 billion in 2020, then $2.09 billion in 2021. Headcount ballooned from under 5,000 to over 6,000, and the stock went vertical. On October 29, 2021, Atlassian hit an all-time closing price of $458.13 per share. At that price, the market was valuing Atlassian at roughly 47 times forward revenue. That's not a business valuation. That's a faith statement. It's investors saying, whatever this company earns today, they believe it will earn vastly more in a future where interest rates stay near zero and the growth story never falters. Both of those assumptions were wrong. By 2022, interest rates were rising. The era of cheap capital that had inflated every SaaS multiple was ending. Atlassian's stock began its long descent. The company wasn't failing. Revenue grew 34% in fiscal 2022. But the valuation premium had been priced for a world that no longer existed. While the stock was compressing, Atlassian was executing one of the riskiest operational moves in its history, forcing its entire customer base onto the cloud. In October 2020, the company announced it would sunset all legacy on-premises server products. New server license sales ended February 2, 2021. Security patches ended February 15, 2024. And in September 2025, Atlassian announced the end-of-life timeline for its data center editions. Full support termination scheduled for March 28, 2029. This was not a gentle migration offer. It was a mandate. You move to cloud or you're on your own. The logic was sound. Maintaining 3 parallel code bases, cloud, server, and data center, was expensive, and it fragmented the product. Moving everyone to the cloud created a unified platform for high-margin recurring subscriptions, better analytics, and eventually AI features. By 2024, more users were active on Atlassian Cloud than on all legacy systems combined. 94% of customers had an active cloud presence. But the migration created real friction. Regulated industries, banking, insurance, government, had data sovereignty requirements that cloud deployments complicated. Some customers resisted, some churned. The transition wasn't free. Atlassian had to build enterprise-grade security compliance, regional data residency, and migration tooling that ran 24 times faster than its predecessor. The company absorbed those costs. The market watched. In March 2023, Atlassian announced its first major layoff. 500 employees, roughly 5% of the workforce. The founders framed it as a rebalancing, moving resources from talent acquisition and program management toward cloud, ITSM, and enterprise features. The severance was generous. Minimum 15 weeks of base salary, accelerated equity vesting, 6 months of healthcare. 3 years later, on March 11, 2026, they did it again. This time, 1,600 employees, approximately 10% of the company. Over 900 of those roles came from engineering. The company's chief technology officer, Rajiv Rajan, stepped down. Scott Farquhar had already departed as co-CEO in August 2024, leaving Cannon Brooks to run the company alone. The reason given for the 2026 cuts was specific and uncomfortable. In February 2026, industry analysts coined a term, the SaaS apocalypse. Within roughly 30 days, approximately $2 trillion in market capitalization evaporated from the technology sector. The iShares Expanded Tech Software ETF fell 22%. The cause wasn't macroeconomics this time, it was structural. Autonomous. AI agents had become capable enough to write code, run tests, generate documentation, and manage task backlogs without human operators. And if you don't need human operators to do those things, you don't need human seats in a per-seat SaaS platform. The pricing model that had made Atlassian, and dozens of companies like it, enormously valuable was suddenly exposed as fragile. Revenue per customer could shrink, not because customers left, but because they needed fewer licenses. Atlassian felt this directly. Its stock dropped 35% after an earnings report revealed the first ever decline in enterprise seat count in the company's history. Jira is a tool built to track human task workflows. If the tasks are increasingly done by agents, the interface becomes optional. Cannon Brooks didn't pretend otherwise. In announcing the 2026 layoffs, he said, "It would be disingenuous to pretend AI doesn't change the mix of skills we need or the number of roles required in certain areas. It does." The countermove was already in motion. Atlassian had launched Rovo, an AI-powered product operating as a cognitive layer across the entire platform. Rovo search indexes both internal Atlassian products and external systems like Google Drive, Slack, and GitHub. Rovo Chat uses what the company calls the Teamwork Graph, a metadata network mapping connections between documents, code, issues, and teams to answer contextual questions. Rovo agents run specialized workflows autonomously. Rovo is priced at $20 per user per month. That's a new revenue stream on top of seats, not a replacement for them. And the early data is significant. By Q1 2026, Rovo had surpassed 5 million monthly active users, a 50% increase quarter over quarter. Enterprise accounts using Rovo grew their annual recurring revenue at approximately twice the rate of non-users. AI credit usage was growing at over 20% month over month. After the earnings report, the stock surged 22.77% in a single session to $84.21. It's still 81% below its 2021 peak. Here's what most coverage of Atlassian misses. The peak valuation was never a measure of the company's worth. It was a measure of how much investors would pay for predictability in a zero-interest rate world. When that world ended, the multiple collapsed, not the business. Revenue kept growing from $2.09 billion in 2021 to $6.19 billion in 2026. The company is more than 3 times larger by that measure. But the market now asks a harder question. What kind of revenue is this, and how durable is the model that generates it? Atlassian spent 24 years building an empire on the idea that software could sell itself. That turned out to be true. Then it built a second empire on the idea that moving everyone to the cloud created an inescapable recurring revenue base. That also turned out to be true. Now it's making a third bet, that the same teamwork graph that made its software sticky for humans makes it indispensable for AI agents too. That the context embedded in decades of organizational data is a moat. No generic large language model can cross. Maybe that's right, maybe it isn't. But notice the pattern. Every time Atlassian's business model faced structural obsolescence, the response was the same. Build the next layer of the system before the current one collapses. The $10,000 credit card company didn't fail. It kept outrunning its own disruption. Whether it can outrun this one is the only question that matters.